Hi, I'm Gwen Preston of Resource Maven with a few comments on why gold is doing so well today. Well, it happened just as expected. Janet Yellen raised rates and gold almost immediately got its groove back. The day of the rate hike, gold jumped almost 2% in sort of 5 trading hours. And miners demonstrated that leverage that we love so much. The GDX, the index of major gold miners, gained something like 8%, while the GDXJ, the junior miners, jumped 11.5%, which is great leverage off a 2% move in gold. In the 5 days since the rate hike, gold has continued to gain. We're up almost 4% over those 5 days, and gold miners are showing strength even on days when the broad stock markets are down. So what's going on? Well, I think there's 3 basic explanations for why gold is doing so well today. The first involves a thing called the PDAC curse. The PDAC curse is a real thing. The world's biggest mining conference happens in Toronto at the beginning of March every year, and it actually influences mining markets. The irony, though, is that everybody assumes the PDAC curse, the stock market slide that's associated with the conference, happens after the conference. But that's only true in bear markets. In bull markets, the PDAC curse actually happens before the conference. Once the conference is over, the markets are free to rebound, and rebound they do, especially when there's a catalyst, this year a rate hike, to spark that rebound. That's exactly what we're seeing right now. The second bit of fundamental rationale for gold's moves right now is just strength. So gold gaining on the rate hike definitely made people talk. It's been a notable event. But what I think is almost more notable is gold's strength in the month leading up to it. Yes, I'm talking about gold's strength in the month where it lost 3.5%. I get that that sounds a bit backwards, but think about what happened during that month. In that period, we had increasing confidence that a rate hike was imminent, increasing dollar strength, US stock markets flirting with all-time highs, and very strong numbers around employment and job creation in America. Those factors all work against gold. If you'd known at the beginning of February that all of those things were happening, you probably would have predicted a bigger decline for gold than just 3.5%. So that slide actually demonstrated fundamental strength for the yellow metal. And the third bit of rationale for why gold is doing well today is why that fundamental strength exists, which is real rates. Yes, the Federal Reserve hiked rates, but it was a pretty dovish move. They didn't change the dot plot. We're not expecting more rate hikes this year, and inflation is increasing. That together means that we're still looking at a situation where real rates are going to remain negative for the time being. And negative real rates are the fundamental driver for gold, always. Taking a bigger step back from sort of European elections to Russian connections, from tax less, spend more plans to sustained negative real rates, gold just has a lot going in its corner right now. So what does that mean? Well, for me, that means my plan is to take advantage of what I think is going to be a bit of a spring run. We're in it right now. I think gold is going to do well in April. And by the end of April, I'm going to be assessing my portfolio, take a look around, and probably lock in some gains. Because the summer doldrums will happen, prices will fall, and then that gives another opportunity to step in, reset your portfolio, and be ready for the fall, which will be the next exciting time for those invested in the gold market.